So welcome back to the Green Swan 2023 conference. Our next guest, Mark Carney, needs no introduction. I think we all remember his seminal speech on the tragedy of the horizon in 2015 that made him the climate pioneer among central bankers. Ever since, his commitment to mobilizing financing against climate change has been an inspiration for all of us. So for all of us, we are very happy and honored to welcome at this conference the United Nations Special Envoy for Climate Action and Finance and co-chair for the Glasgow Finance Alliance for Net Zero. Welcome, Mark, and the floor is yours.
Thank you very much, Luis. That's too kind of an introduction, but it's a great honor for me and pleasure to be part of this important conference. And I'd like to thank the BIS, the Central Bank of Chile, South African Reserve Bank, and the NGFS for convening what really is an essential conversation between central banks about the real economy transition. And I think, our starting point today must be to recognize that whether it is fully addressed or ignored, climate change is macro critical. Climate policy and the pace of the transition directly impact the efficacy of fiscal and monetary policies, as well as their interactions with the financial system, will heavily influence not just the pace of job and wealth creation, but fundamentals for central banks of price and financial stability. Like the rate of inflation, the degree of climate change is a choice, and it's one that affects the prosperity and welfare of everyone on this planet. And those choices will, as I said, fundamentally influence price and financial stability. So central banks are rightly performing their essential roles when they provide the supervisory roles and the market infrastructure for financial institutions, for those institutions to manage climate-related financial risks and to promote an orderly transition in the real economy. Now, it's been a while, but I gave that speech in part because of my firsthand experience as governor of the Bank of England. And one of the elements of that role is to be the ultimate supervisor for the world's fourth largest insurance industry. And that industry, including the large reinsurance industry at Lloyd's of London, knew well that since the 1980s, the number of extreme weather events had tripled. This is going back 10 years, it's gone up even further. But at that point, the tripling of those extreme weather events had caused an 8-fold increase in insured property destruction, and those numbers are adjusted for inflation, of course. An even greater value of assets is uninsured. And so if we don't achieve our Paris goals, these losses are expected to rise sharply. Coastal flooding to increase by up to 50% by the end of this century, threatening assets worth 1/4 of global GDP. And in parallel, there are estimates that over the balance of the century, climate change could cause the equivalent of a decade of no economic growth, and the livelihoods of over 1 billion people will be directly affected by the spread of lethal climatic conditions. Now, let me balance this bleak summary, and I'm thrilled that Nick Stern is on the panel because he's rightly emphasized the point of the upside of addressing climate change, a multi-decade investment boom after a decades-long drought, in his words, the growth story of the 21st century. The IEA calculates that to be on track for 1.5-degree warming, global investment in energy infrastructure alone must rise by full 2 percentage points of global GDP. Investment on this scale would completely reverse the investment shortfall, the twin of the savings glut that has emerged since the millennium. And all else equal, this would increase the equilibrium real rate of interest, or R star, reducing the risk that monetary policy is trapped at the effective lower bound. Now, while it's fundamentally positive and less inflationary than keeping with the current insufficient climate policies, in the near term, the net zero transition can be expected to put slight upward pressure on inflation during the first decade of the transition, until the lower levelized costs of clean energy kick in and weigh on prices thereafter. And of course, the NGFS net zero scenarios have done a service by providing a comprehensive assessment of the price dynamics. Now, we know, as central bankers, we know that in inflationary environments, fiscal discipline should complement monetary tightening. And this will be challenging over the medium terms as governments pay a series of insurance premiums to build more resilient economies, including support for the onshoring of technologies and supply chains, greater spending on defense, healthcare, and the reskilling of workers. And given these many demands, fiscal capacity for climate action must be targeted and complemented by clear frameworks that drive private investments and innovation. And as Secretary Yellen and I have emphasized, as is the case for monetary policy, climate policy credibility can do much of the work, lowering the amount of future tightening of climate policies required, smoothing the transition, and lowering inflationary impacts while maximizing growth. For this virtuous cycle or circle to operate to full effect, it's vital that the financial system is both fully informed and fit for the transition. And the prospect of that has been greatly enhanced by the leadership of central banks. In particular, central banks, individually as supervisors and macroprudential managers, and collectively at the BIS and the FSB, have promoted better climate disclosure, a process that will culminate later this month with the release of the ISSB's final climate disclosure standard based on the voluntary TCFD. This will help ensure that financial institutions in over 130 countries have consistent, comparable, and decision-useful information, the information they need to manage climate-related risks and opportunities. In parallel, near universal country commitments to net zero have provided a North Star for companies and the financial sector. Over 570 financial institutions from 50 countries have now committed to net zero by 2050 through the alliances that comprise GFANZ. And GFANZ continues to grow with new subsectors like venture capital and new regional networks in Asia Pacific, Africa, and Latin America. And all of its members are focused on financing the transition in the real economy, today's topic. Collectively, these changes are bringing the real economy transition further into central banks and regulators' financial stability and prudential mandates. And as I said a moment ago, or implied a moment ago, central bankers have been far from idle. The NGFS has pioneered the development of climate scenarios for both company and financial institution scenario analysis and system-wide stress testing. And collectively, this helps policymakers better understand how the risks of climate change could be realized across economies, and it helps them promote actions to mitigate those risks. As we've learned through a series of crises over the past few decades, in the words of Tim Geithner, plan beats no plan. And for that, institutions that have strategies resilient to the net zero transition, and institutions have strategies that are resilient to the net zero transition, the TCFD has recommended that all companies and financial institutions should develop and disclose their net zero transition plans. To further that end, GFANZ developed for COP27 last year a common global framework for net zero transition plans, which our members are now implementing. Drawing on extensive stakeholder feedback and guided by experts from leading technical organizations, this practitioner-developed framework outlines the metrics, the governance, and the strategies that financial institutions and companies should adopt to translate climate pledges into action. This transition plan framework provides a clear definition of how transition finance can support decarbonization in the real economy. And of course, this begins with climate solutions and companies that are already aligned with net zero, but it importantly includes the financing of high-emitting companies with credible transition plans and funding plans, as well as the accelerated and managed phase-out of assets that will be stranded by the transition. It's essential that central banks and regulators engage with the transition plans of financial institutions, both in the context of scenario analysis and in routine supervision. Therefore, both the UN and GFANZ welcomes the work of the NGFS on transition plans and the Basel Committee's Task Force on Climate Risks workstream on transition planning. As in climate disclosure, A common global approach to transition planning will minimize risk to financial stability and help smooth the real economy transition. What we want financial institutions and companies to focus on is the real work of developing and implementing transition strategies, not the make work of developing different plans or reporting different plans for different purposes and in different jurisdictions. And all stakeholders need to be able to compare across transition plans in order to assess the credibility of strategies against net zero pathways. And therefore, central banks and prudential regulators' efforts should partner with securities regulators as much as possible to ensure that institutions are developing comprehensive, credible, and comparable transition plans that serve multiple purposes. In short, central banks and regulators should be working in international fora, such as the BIS and at the FSB, to agree upon the need for common global approach that minimizes fragmentation, in effect, building on the lessons of their success with the TCFD. So to conclude and move to the panel, it's fashionable to compare the current macroeconomic situation to the 1970s and early 1980s. But history is merely echoing. The climate crisis means we are in a totally different universe. And I'd remind that although the monetary tightening of the Volcker Fed is rightly and firmly in the central banking pantheon, the very human cost of that disinflation should not be forgotten. A brutal recession, millions of unemployed, a sacrifice ratio necessitated by a string of errors and timid actions that preceded. High and volatile inflation at least can be vanquished. It need not be a permanent condition, and I'm very confident that central banks of today will ensure that's not the case. But it's not the same, and the same cannot be said of climate change. The world is on course to exhaust our entire carbon budget for a 1.5-degree world this decade. And until very recently, countries have been caught in a timidity trap, dithering towards climate disaster, a drift that, if allowed to continue, will at best set up a future climate Minsky moment, with abrupt and wrenching economic adjustments, stranding trillions of dollars of assets, and impairing financial, price, and potentially geopolitical stability. Central banks have a duty to prepare for this possibility and do what they can to dampen the financial sector multipliers. As we've learned over decades, part of the job of a central banker is to prepare for failure. But more positively, in recent years, climate policy momentum is beginning to change. It's beginning to accelerate. And this brings a recognition that through credible policy coordination, we can catalyze the enormous private investment that's necessary to address climate change, and in the process will create jobs, accelerate growth, smooth inflation, and promote energy security. Through climate-related financial disclosure, climate stress tests, and a common approach to net zero transition plans, central banks can fulfill their essential role supporting the market infrastructure that the world needs for whatever transition society ultimately chooses. And with that, thank you again for this platform, and it's my pleasure and honor to hand over to Stephanie for what should be a fascinating panel.